May 31st was the deadline for quarterly financial results for a number of smaller scale producers out there. So naturally, we've been hit with another wave of earnings to cover. One of the latest names to report is Guanajuato Silver, who posted their Q1 results last Wednesday. Naturally, we had some questions to send off to management and some catching up to do. So here we are. Let's dive in. Don't miss the Rural Symposium for Natural Resource Investing happening July 7th in Boca Raton. If you can't make it in person, that's not a problem. You can get your ticket to watch live online or on demand. We'll be there with the deep dive, so if you make it out to Boca, come say hi at our booth. If you want to sign up, click on the link in the description to get your pass. Guanajuato Silver in the first quarter of 2024 posted top-line revenue of $21.3 million, which was a new record for the company and a 12% improvement versus the $19 million in revenue reported in the fourth quarter of 2024. The revenue here followed the sale of 743,000 ounces of silver equivalent in the first quarter, which was flat on a quarter-over-quarter basis. Silver was sold at an average price of $31.88 an ounce in the quarter, a 1% improvement from the $31.44 an ounce average recorded in Q4, while gold pricing improved 7%, moving from $26.64 to $28.43 an ounce. While revenue was up 12% quarter over quarter, cost of sales increased a marginal 1% to $16.5 million in the first quarter, leading to 82% growth in mine operating income, which jumped from $2.67 million to $4.85 million quarter over quarter. Despite the improvements at the mine level, however, Guanajuato still posted a net loss of $2.3 million, or 0 cents per share, as compared to a loss of $2.4 million or 1 cent per share in the fourth quarter. The reason here is derivatives. As per the communications team over at Guanajuato Silver, the loss here is largely a result of the gold credit facility currently outstanding with Ocean Partners. It's a non-cash loss that occurs when the price of gold goes up. The short of it here is that Guanajuato has an outstanding loan that is being repaid in the form of gold bullion. Every month, Guanajuato ships to Ocean Partners 131.7 ounces of gold as part of the repayment plan. That gold on paper was initially valued at whatever the gold price was at the time of the agreement. But now that it's time to repay the debt, the price of gold has gone up, and those 131.7 ounces are worth more now than they were at the time of signing. So Guanajuato has to take a non-cash loss as a result, which represents the difference in value. The higher the price of gold goes, the higher the non-cash loss that gets recorded. And considering that this monthly payment is only about 10% of gold production, Q1 averaged 1,115 ounces of gold production a month. Guanajuato is happy to keep taking a paper loss here as the price of gold goes higher because, well, who cares when you're making bank on 90% of your monthly gold production? Anyways, EBITDA during the first quarter amounted to just over $1 million, which was down 53% from the fourth quarter's $2.26 million EBITDA figure. But adjusted EBITDA was up 135% quarter over quarter from $1.8 million to $4.1 million. Finally, mine operating cash flows before taxes was up 61%, going from $3.9 million to $6.3 million. However, the working capital position deteriorated, dropping from negative $15.4 million to negative $17.1 million, with Guanajuato ending the quarter with $2.2 million on the balance sheet. When we asked the company about this decline and how they aim to rectify it, the answer was that they aim to boost production by 10 to 15% over the course of the year, which would have a dramatic impact on project economics, and that achieving this benchmark increase as a minimum will be the focus for the remaining quarters of 2025. All right, let's take a look at the production side of things. The first quarter of 2025 saw tons milled decline by 6% on a quarter-over-quarter basis, dropping from 135 to 128,000 tons. But that decline in milling didn't really seem to have an impact on the final output. Silver production in Q1 was down 1%, falling to 380,000 ounces from 385, while gold production improved 1%, going from 3,298 ounces to 3,347 ounces. Lead production, meanwhile, declined 5% to 699,000 pounds, while zinc production was down 8% to 909,000 pounds. On a silver equivalent basis, however, those gold ounces are all that mattered, with production on an equivalent basis rising from 730,000 ounces to 738. In terms of costing, cost per ton was up 3%, going from $106 to $109, which was largely a result of the decline in tons milled. On a unit basis, costing was actually down, with cash cost per silver equivalent ounce falling from $19.84 to $19.19 an ounce, a 3% improvement, while AISC per silver equivalent ounce fell from $24.98 to $23.41 an ounce, a 6% improvement. While costing improved in terms of the aggregate across all operations, two mines, VMC and San Ignacio, stood out, with AISC coming in at $29.13 an ounce and $27.77 an ounce, respectively, while the other two mines in the portfolio, El Cubo and Tapia, saw AISC in the high teens. So we asked Guanajuato about it. Their response here was that it simply comes down to production, which is obvious. But then they elaborated, saying that any production shortfall largely comes down to care and maintenance of the mining fleet, which is an area they intend to place an outsized focus on, with current efforts including the improving of repair shops and streamlining equipment suppliers so as to reduce challenges associated with managing a slew of different parts and services. Care and maintenance practices are said to be a major priority for the company moving forward as part of an effort to remove volatility from operations. All right, so let's wrap it up. Q1 was a decent quarter for Guanajuato, provided you can wrap your head around the whole net loss not being a huge deal. Moving forward, provided they can continue to bring the cost of production down, things should go decently well. The big issue here is obviously cash flow and getting to positive working capital. Not to mention, improvements on costing as well as production are needed to get them there. And in light of this week's movement in the price of silver, things seem to be trending positively overall for producers, which means more cash flow. In the interim, they could always raise equity, which seems to generally be in the works with this name. All right, everybody, thanks for watching. If you enjoyed this video, do me a favor, smash that like button, subscribe, ring that notification bell. Guys, if there's stories you want us to cover that we haven't covered, let me know in the comments section. Also, stories in the mining world that you want us to look into, please let us know. We're always looking for ideas. We want to keep bringing you guys great content. We're going to keep reaching out to companies to get you guys those additional insights you're not getting anywhere else. Thanks for watching, everyone.